I'm Mark Draper. Joining me today is Hamish Douglas, the CEO of Magellan Financial Group. Hamish, there's been a lot of movement in the markets in the last week, particularly upwards for a change on the anticipation of a remedy for the Euro debt crisis. Can you give us an update on what's been happening in the last period of time?
Yeah,
and where you see things going, by the way.
Mark, the European crisis is really the epicentre of why we've seen so much volatility in markets. It's affected China, China has affected Australia, it's affected the United States. It has really affected sentiment around the world. We have been relatively relaxed on the European issues. There are two fundamental issues in Europe going on at the moment. One, there is a solvency issue, and particularly centred around Greece, where Greece is an insolvent nation that has a possibility of collapsing. And if it was an uncontrolled default scenario, it could cause a spectacular financial implosion. In Europe, we think that is a very low probability of happening, and actually the bailout facility that was announced in July, we have now 16 of the 17 governments who have approved that facility.
Slovakia was the one that
Slovakia is the one government that hasn't yet approved it. It got voted down earlier this week. It will be approved, in our view, later this week, if you understand Slovakian politics. There's a coalition government. One of the parties in the four-party coalition voted against it. The government lost a census motion, no confidence motion. The opposition party, now that has happened, have said they're going to support the vote to vote it through at the end of this week. So we are very confident that the bailout package and these very important tools that can address a controlled default scenario in Greece are actually going to be enacted, and therefore we think it is incredibly reduced risk that that's going to happen. And now it's becoming clearer, I think the markets are becoming clearer, that the Greece situation probably isn't the fear situation that people had. The other issue we have in Europe is really dealing with two issues. One of the issues is bank recapitalisation, and they have started to talk about the need to recapitalise banks instead of having their head in the sand. The market's been reacting positively to that, although we haven't had the final details, and that will probably come out at the G20 meeting on the 3rd and 4th of November. The bigger issue and the more complex issue in Europe is how do we deal with some larger economies who are solvent but are vulnerable to bond rates going up, and that would be Italy and Spain in particular. Yep. And if their bond rates were pushed up to such high levels, they're at 5.5% at the moment, but imagine if they went to 8 or 10%. These countries could actually become insolvent if the interest bill on their government debt became so overwhelming. Yes. So how do you stop interest rates in those other markets being pushed up in the bond markets, which could cause a self-perpetuating insolvency problem, and one which may become too big to deal with? Yep. We have been saying for quite some time now that we believe the policymakers are actively working on this problem. They understand this issue. Yes. The problem is the market hasn't really understood whether they are working on it, and if they are working on it, haven't had any clue what they're actually working on. Our view is what's going to happen here is we think it is likely a solution, something like this, is going to come on the table. Whether it comes by the 3rd and 4th of November is another issue. I think they're actively working to try and get there. We believe out of the stability mechanism, which has $440 billion worth of firepower, actually not enough firepower on its own to deal with this issue. Italy is the 3rd largest bond market in the world. So it's very, very large. You need a firepower in the trillions of euros. Yes. To deal with this potentially in this issue. We believe what they will do is something along these lines. We think they may take, say, $50 billion of capital out of the stability mechanism and inject it into a new sovereign bank in Europe, or an existing sovereign bank in Europe. And with $50 billion of capital, the way capital rules would work, it could actually get leveraged up to, say, $2.5 trillion of assets. Right. And at $2.5 trillion of assets, it would have very, very strong capital ratios at 50 billion if its only mandate was to buy sovereign bonds. And once it had an entity set up like that, it would then be able to say to the world, bond yields are not going to rise above certain levels in countries like Spain and Italy. Yeah. And we think that would absolutely put a lid on the fear of this issue that appears to be too big to deal with.
It would certainly send a very strong message to the speculators who are betting against
Well, the
that.
speculators, it would be very dangerous to speculate, because if they wanted to short Spanish bonds, this facility could step in and buy against them, and they could lose a lot of money in shorting the bonds. So I just don't think it would happen.
Yeah.
But the problem, there isn't a bazooka in the room at the moment that can deal with this issue. We believe the policymakers are absolutely focused on this issue. This is similar, I think, to what Geithner suggested when he went over to Europe. I suspect they were already working on it, so they reacted quite harshly to Mr. Geithner, who was literally calling them a bunch of idiots by saying, "Why don't you do something like this?" I think they have been working on something like this. I think this would satisfy the ECB and the Bundesbank, where they don't want the ECB, the European Central Bank, effectively doing these bond purchases in its own regard, because that could effectively do something called quantitative easing, which would create inflation risks within Europe. The way I'm thinking is there is no increase in the money supply by separating it from the European Central Bank, and you need it to then separate also from the European Stability Mechanism. That's why it needs to be something separate. So let's see how that plays out. We're fairly confident. It's more complex because you need to do it in a way that hopefully you don't need more parliamentary approvals.
Yes.
But if they can thread the eye of the needle, Europe may well settle down more quickly than people think. That doesn't mean Europe's off to the races. It just means Europe's not going to implode.
Yes.
Europe has a very, very challenging 5 to 10 years ahead of them of low growth and dealing with these very high debt levels. But our view is Europe isn't going to collapse and send the world onto the verge of another depression.
And on that point, what do you think is actually priced into the markets at the moment, particularly in terms of Europe and Greece?
Yeah, the market has partially priced in a collapse in Europe. It isn't fully priced in, because if Europe does collapse, we haven't seen anything yet. 2009 would look like the teddy bear's picnic if this really happened. So it hasn't fully priced in that scenario, but it is pricing in a partial scenario.
Yes.
That the Europeans just can't get ahead of this problem. If they do address some of these issues, as we believe they will, the market valuations don't look onerous at all to us if the most probable scenario plays out. I'm not saying it's guaranteed it's going to play out the way we're thinking. We just think it's very likely to play out this way.
Yeah. Hamish, who's one of the best big picture macro thinkers in Australia, thanks for your time, and trust you've got some good information from that. For more updates, stay tuned to our website.